In this session, let's talk about a very high level overview of the risk management. We'll be talking about why this risk management is very much essential, what are the different kinds of risks, what are the key things that we need to look at in an organization which is more interested in going towards risk management. All these things are looked at from an introductory perspective. So, just if we look at the introduction to it, any future decision, first thing is it is very difficult to predict, right? Risk is all about the future and the uncertainty to determine the future. We all accept the fact. Now, we are all not gods to typically come out with exact identification of what is going to happen in future. So the first and foremost thing we have to appreciate is the future is difficult to predict. It could be the prediction of prices, it could be prediction of events, but anything is difficult to predict. But one thing that has been observed over the past is we can take actions in such a way that we can manage the uncertainties. We can try mitigating the uncertainties. We are not eliminating. There is a difference between these two words. Eliminate versus mitigate. Mitigate is where the risk management is trying to work out, not eliminate. Uncertainty with respect to the future is inevitable concept. We have to appreciate it. But we are using the world of risk management to try to reduce that uncertainty. First of all, let's try to look at it in a simple way. I might very well get a job without studying anything. You can bring about examples of a lot of entrepreneurs who are college dropouts, but who have become really successful in life, who have become billionaires and millionaires. So, taking them on one side, can I make a statement that there is no need to study to become a millionaire or a billionaire? There is some level of fact in that. If that's the case, why are we going through the formal education program? Why are we reading through various subjects? Why are we getting through different concepts and technologies and whatnot? What is the need? If we can become a millionaire or a billionaire without any amount of study. Because we had literally a lot of examples in the real world. On one side, probably a study publishes that majority of or a good proportion of the most successful people need not be highly educated people. There might be some fact, they are exceptions. Now, why are we studying? The reason being, if I am not studying, probably my future is uncertain. I may become a millionaire, I may go into rags. Anything is possible. But by going through a formal education, I'm trying to do a mitigation of the uncertainty of my future. I hope I'm getting the point across to you. Now that is what is risk management all about. Future, the uncertainties we are trying to address. Now why are we studying there? Because historically we have some kind of evidences which say that people who have been undergoing the formal education program, they are able to make their living quite comfortably. Now, which means I'm understanding the past, trying to do some kind of analysis based on the past available data and information, and based on that come out with a conclusion which can help me to reduce my uncertainty for the future. That is what is all about risk management. So giving a formalization to it, I'm identifying, I'm measuring and evaluating the consequences at every stage. If I'm not studying, what is going to happen? There are possibilities. 1, 2, 3. I may become a billionaire. I may just meet my ends going on. I may even not be able to make my ends going. Now I'm evaluating the various consequences, saying what is the chance that I can become this? What is the chance that I can become this? What is the chance that I can go into rags? We are looking at various consequences, evaluating the consequences, and based on that, coming out with an action plan, which simply says step 1, 2, 3, 4, 10. These are what I'm going to do in order to reduce the uncertainty of the future. So every step that we are designing is going to be a challenge, but the more effectively we are able to implement that step, we have done a proper risk management. So just to formalize the definition, risk management is always a continual process. It's not a one day exercise, 1 week exercise. It's a continuous process where the corporate really focuses on reducing the uncertainties. What are the uncertainties for the corporate? The uncertainty could be in terms of earnings. The uncertainty could be in terms of share price. The uncertainty could be in terms of employees turnover. There are lots and lots of uncertainties. Uncertainties in terms of the profit portfolio, the project portfolio. All these things go as a part of uncertainties. Now, how well I implement my risk management activity depends on to what extent I am able to reduce these uncertainties. So never look at risk management as a defensive approach. It is the active selection of the type and the level of each of the risk. We are not saying that risk management means don't take risk. These two are two different words, statements altogether. Risk management never talks about not to take risk. Assess the risk, take it strategically. Actively select the type and the level of risk based on the risk appetite, based on your understanding of how much should be the target profitability without too much of fluctuations in it. So risk management and risk taking, we can't look at them in as two different stuff. They are the two sides of the same coin. One cannot exist without the other. When I'm taking a risk, it's not that I'll invest all my money in a lottery. That is what is the real risk taking. But if I'm doing a proper plan and taking a risk, we call it as risk management. We are not talking of just a simple risk taking, right? So what we really have to understand is we have to get out of that notion that risk management is not about risk taking, it's about risk controlling. No, that's not the case. Once we change our mindset and try to understand risk management is all about taking appropriate risks, taking calculated risks so that we can maximize the profit with minimization of the risk. Instead of just looking at maximization of the profit, we are adding one more term to it, maximum risk with maximum returns with minimum amount of risk. So risk to return ratio is the lowest possible. And this risk management today is becoming a creative force in the entire financial market. Just because of this world of risk management, innovative products are coming into the market. We have seen credit derivatives over the last decade, where the sole aim of the credit derivatives is to redistribute the credit exposure from those who don't want to take the risk to those who want to take the exposure to those credits. So there is a transfer of risk from one party to the other, from a risk averse party to a risk loving party. There is a kind of a spread of the risk, transfer of the risk that is happening. So banks are coming into picture, hedge funds are coming into picture, means there are so many opportunities that are available today, so many new instruments getting created under this notion of risk management, transferring the risk to the parties who are willing to take it, who are able to take it, so that the risk is overall spread in that system across rather than one party accumulating it or cascading it. Risk is diversified in this process rather than getting accumulated and act as a cascading effect. So, but what we really see is risk management, even though a lot of hype is created around it, a lot of buzz is created around it. It has been inconsistent in terms of preventing market disruptions, though there are lots and lots of risk management plans that have been implemented before 2007. We were not able to avoid the 2007 global disaster or any of the business accounting scandals that have been unearthed in the last couple of decades. Any kind of risk management was not able to unearth all of them, though some of them were successfully handled much before, successfully identified and exploded much before. Some of them they could not get identified till the last. So that is where some improvements should still come out in the world of risk management, and that orientation should get developed within the organization. And probably what we see is especially the herd behavior of the risk managers. That is one more major drawback. If at all we see that a crisis has come out, we see that a lot of risk managers they go towards flight to safety mode. All the risky investments will get sold, reducing the prices, values, even increasing the losses to the organization. That's one thing where a risk manager should really be focusing on. And whatever the sophisticated financial engineering instruments that have come out, credit default swaps, collateralized debt obligations, asset backed securities, mortgage backed securities, all these sophisticated financially engineered instruments that have come out in the last couple of decades, they cover up the real economic condition of poorly performing firms because they really feel they have transferred their risk. They are not too much at loss or too much at risk. So this is where some improvisations are very much expected towards risk management. But of course, risk management is becoming a powerful and a creative force, and it will become a creative force for the years to come. And we need to understand one key statement which I really like. Any risk management tool or a technology you implement in your organization, it is double edged. Because every tool, I can use it either to reduce my risk or to get exposure to that risk. Now, to what extent I am reducing it? So, in a technology, in a technical sense, we call I can use any tool either to hedge my risk or to speculate my risk. Now, to for what reason the company is going to use and how much of hedging it is doing, how much of speculation it is doing, that entirely boils down to the risk appetite of the organization. So, how well the risk management tool and technology is used drives to what extent the company is successful with respect to risk management. And today it has gone to such a space that I can't leave risk management only to the rocket scientists or the quantitative specialists. Risk management is the need of everyone. Understanding risk management is essential to each and every employee as a part of the corporate. It's not a mathematical tool, it's not purely scientific kind of process. It's a regular implementation process, operations process, which has to go into the nerves of each and every employee so that the corporate can be successful out of the proper implementation of it. And typically, we might be knowing this process. Whenever we talk about a good risk management process, it all starts from identifying the various risk exposures. What are the different sources where uncertainty can come out for the business? Any source of uncertainty, just identify them. And after that, see what are the different kinds of tools and techniques that are there to measure and estimate the risk exposure. There, for each kind of risk, there are different kinds of tools and techniques that are available. Value at risk, standard deviation, risk adjusted return on capital. So there are so many tools that are available. So depending on the most appropriate tool for that particular type of risk, try to identify, measure and estimate the risk exposure. If at all you are able to find some instruments in the capital market where you can shift or trade that particular risk, just get into it. If it is not your core business risk and you are not going to monitor it day in and day out, better transfer it to a third party. Now, for each of the risk, assess the effect of the exposures, how much it is going to impact the profitability, how much it is going to impact the share price or any other variables, to what extent it can worsen your debt rating. So it could very well be targeted towards the various objectives. So identify and assess what is the impact of each of these exposures. And if at all you are going forward towards the transferring of the risk, identify how much does it cost to transfer it versus retaining it. Do a kind of cost benefit analysis, because at the end the benefit should be more than the cost that you are incurring in doing the transferring of it. And based on that, finally arrive at a strategy in terms of what you are going to do. Are you going to avoid that risk, means don't take that risk at all? Are you going to transfer it through the capital market or probably take an insurance policy for that? In what way are you going to transfer it? Are you going to come out with some kind of internal mechanisms to reduce it, or are you going to retain it? Some such kind of a mechanism need to be worked out for each of the different kinds of risks, and make it as a continuous exercise. Keep evaluating the performance of the organization in terms of the various goals and objectives to see whether the implementation of this risk management strategy has improvised any kind of profitability or has reduced the volatility in the profits or any of these. Based on that, either continue the strategy or revise the strategy. That is how any risk management process works out. Now, just coming into the world of risk, first thing, it is abstract. Though we keep defining uncertainty from the expected, so anything that is uncertain, unexpected, that is what we are calling as risk. So the definition is very abstract, but in the real world, all of us in some form or the other do a better workout between the risk and the expected return. We always say, why don't you put your money here? The simple word comes, no, it's a risk. What do you mean by that? You might have defined risk in a different way. It may not be the same as the universally accepted definition, but you are definitely going to use that word risk. You know what it means as a concept. You may not be able to define it concretely. That's the reason I'm calling risk is more abstract. So simply put, it's a kind of volatility leading to unexpected losses. Anytime, any business we get into, there are two dimensions to the losses. One, we call them as expected, because we are doing a business, we are into a risk. We are taking a risk when we are doing a business. So some amount of loss is very much inevitable in the business. So that kind of loss which we are willing and ready to bear, we call it as expected loss, and that is not a risk. But anything to do with the unexpected, I have expected that I will be losing 10,000 bucks in the next year. At the max, I can lose, let's say, 10,000 bucks in the next year. But it turned out to be 40,000, which means my expected loss is 10,000, unexpected is the remaining 30. And that unexpected, it might have given me a profit in 1 year, it might have given me a loss of 100,000 in another year. This year it just gave me 30,000 extra loss. So they need to be clearly differentiated. What is expected loss? What is unexpected loss? Even in our real world, we do all these things. It's just that we are taking the same concept into the typical corporate world. But never think that it is synonymous with the size of a cost. A costly thing, a particular project in which we have invested heavily, that need not be a high risky project. Whereas on the other side, we might have invested very little into it, but at the same time, it could be a very risky investment. So risky or uncertainty cannot be looked at as a synonym to the size of the risk. We just need to evaluate the output, outcome that is going to come out of each of those, and based on that, the risk is coming out. So, because in some cases, even for biggest of the organizations, any big cost, in some cases, it is well planned so that the uncertainty is very much reduced in it. Wherever we are looking at the cost, not a high cost, but the cost which is unpredictably going higher. I have expected that the cost of my materials is going to be X, but it has gone up to X plus 10. And unpredictably high cost coming up, or some new unexpected problem coming up which has added up to my cost and worsened up my situation. Those are the things that are coming into the world of risk. So the variability, they are completely variable. I can't predict them. The only way I can get into the estimation of them is understand the past heavily, try visualizing for the future. So the formal way of understanding risk, that's the reason comes out. The formal way to understand risk is look at the data, use some kind of calculations on the data, use statistics to typically define the extent and the potential cost of the exposure. How much can you lose? And if at all you can modify something, if at all you can implement something to reduce it, what is going to be the cost of it? Identify the various risk factors that are contributing to the volatility of your earnings. What is causing the volatility? Identify the various factors. For each of the factors, identify what is the probability of occurrence. Okay, my business profits. I'll identify one of the factors that could contribute to a reduction in the profit is the attrition of my employees. Now I want to know what is the probability that the attrition is high. For that I'll typically expect an attrition level, expected attrition level 3%. So actual could be much less than that or much more than that. Now, what is the probability that the attrition will be greater than 3%? I have to really assess. How do I assess it? Probably I may use my past data of the organization, or if there are any other external survey reports, I'll use them, or I'll look at my competitors if there is some kind of information that is available, or I'll do my own survey. Any of the mechanism to typically identify what is the probability that the loss is going to occur and the severity in case the loss is going to occur, in case the attrition is going to be much higher, what is the amount that I can lose. So we are trying to identify the various factors that are driving the volatility. Based on that, trying to compute the probability of the various outcomes and try to see the distribution. Okay, there is some probability that my loss is going to be 100,000, some probability that it can go up to 200,000, some probability that it can go up to 500,000, some probability that it can touch 1 million. Now there are different possibilities and the different amounts of losses. I can plot it in a graph and try to identify the distribution that is associated with it so that I can plan my projections much comfortably. Based on that, I'm going to set the risk appetite of the organization, wherein we are defining the boundaries on the future risk that the firm is willing to take. Any risk value that is going beyond the limits, I may take an action, but until it is within that particular limits, I may let it go. So I am trying to specify the maximum loss the company is willing to tolerate at a given level of confidence. That is what we are defining as the risk appetite. It can very well say that with 99% confidence, I don't want my target debt rating to go below AA. Or with 99% confidence, I don't want the loss in the next 1 year to go above 10,000 bucks. So this is the way I'm trying to define my risk appetite and risk tolerance limits for the various kinds of risk that I can identify. Based on that, compute the expected loss, which is a part of the cost of doing business. So that is not the risk for me, because any business there is some amount of expected loss that comes into it. So that expected loss, we are already pricing it into the products and the interest rates. So that should not be treated as a risk. Only the unexpected part of it is what is getting treated as a risk. And in some cases, there could be heavy correlation among those unexpected losses, which could result in correlation breakdowns as well. Sometimes the risk 1 and risk 2 may act as a natural hedge, but in some cases, a correlation breakdown can happen, which could result in, if this risk is increasing, even this risk could start increasing, having an overall bad impact on the entire system. So, not just understanding of the risk in isolation, but also try looking at the level of interaction that is present between each of the risks, the level of correlation that is coming into each of these risks. Try to formulate whether there is any possibility of a correlation breakdown and clustering of the defaults occurring. And we also need to understand that during a crisis, when lots and lots of default are happening, even the recovery rates go lower and lower, which means for different economic scenarios, I may have to interpret the possibility of occurrence of a loss, the impact of the loss in a different manner, and take actions accordingly. That is what is a very core important aspect of effective risk management, right? From here, yeah. Now let's move on for what is the key task for the companies to handle the risk management. First thing, develop confidence that it has the capacity and capability to assess and measure the unexpected loss levels with various activities. It has the real amount of skills. It is going to assess and measure the unexpected loss levels with various activities. That is one thing, the company has to develop confidence in itself. And just as a driver to that, it accumulates sufficient capital and deploy other risk management techniques to protect against the potential unexpected loss levels. One, keep capital aside in case the loss comes up. It has the sufficient financial resources to attack that. Any other risk management technique to protect itself against the potential unexpected loss levels. Appropriate returns from various risky activities once the cost of risk capital is taken into account. Finally, communicate with the various stakeholders about the target risk profile of the company. That is what the company really needs to do. So, as a quick steps, understand the risk of the business. What are the various activities which could result in uncertainties in earnings? Measure them accurately. Come out with appropriate frameworks to identify the risk, to categorize the risk, to compute the severity and the probability of the occurrence of the risk. So measure the risk, the impact of the risk against the potential rewards and the business goals. To what extent we are going to withstand the unexpected scenario, but a possible scenario but unexpected, can come up with a very small chance. To what extent we are ready to bear that. Capture the risk adjusted reward more and more. Take the benefit by implementing effective practices. That is what is a target for the various companies to handle risk management effectively. So just to differentiate between risk and return, we know that this is a statement. Higher risk means higher expected return. If I am taking more risk, the main intention is I am in search of higher expected return. So that statement is clear. but the level of transparency between the two is very much volatile. And that's where comes the understanding of the risk management. Because the investor's appetite, today I might feel that I am ready to take this much of risk. I don't mind losing 10,000 bucks on this investment. That is what is my appetite today. But in real world, what we see is the appetite for some kind of risk keep changing. Today, I may be more willing to take risk on that particular security, but from tomorrow, my risk potential, risk levels will actually come down. So this is where the companies need to be vigilant about. Large losses typically have been observed. See, the large losses in the future, in many of the cases, they have come out from those kind of activities which are targeted towards development of short-term profits. So this is where the company's risk management team needs to be careful about. There is a potential of large losses from the activities which are generated with an intention to create a short-term profit, making it attractive in the short term rather than looking at the long-term big picture. This is where the risk management practice of the company goes poorer and poorer. They exaggerate the potential returns. Every poorly performed company, poor risk management practices, I can directly assess based on the way they are exaggerating the potential returns. They show up, we can make 20% profit. But when the question comes up with how much risk, they keep saying, no, there's not much. They try to underplay the risk that they are going to take with an overplay on the return. That is where the risk management practice is very poor among those organizations. Even the compensation and incentive schemes, if they are directed more and more towards the profit or stock price rather than effective risk management practices, rather than the volatilities, if their focus is on the absolute numbers, then I can clearly make out that the risk management practices in this particular company are more and more poorer. The bonuses, whatever they are paid today in the current structure, the moment you make a profit, we pay a bonus. So the move is always towards the generation of the short-term profit. So long-term big picture gets omitted out wherever we try to pay the bonuses out of the current short-term profits. So the overall picture, the risk management approach, all of them get diluted if the companies are more and more declaring incentives based on the short-term profitability. So one important area for workout and improvement by the organizations. Majority of the firms lack the discipline to adjust their present performance measures so that they are in line with the future. They keep tampering them. They don't want to maintain a level of performance measures consistently so that they can compare the past with the present. And very interesting line that I liked, I just brought it word by word. History shows that when the stakes are high enough, when things are going well, when the industry is doing very well, when the markets are doing well, regulators across the world, they have colluded with the local banking industries to allow the firms to misrecord and misvalue risky assets. So showing show overvaluing the risky assets, the regulators they did not take stringent action against it. There, when things are going on well, the risk approach, the risk measurement, risk management approach is going down and down. Now, just to look at what are the different kinds of risks that can be faced by an organization, we can classify it as a credit risk. One, the simple way to define it is any kind of loss the company is going to incur because of the factors that change the credit quality of an asset. It could be credit degradation, Credit downgrading done by rating agencies, that is treated as a part of the credit risk. Any kind of default in terms of payment, default could work out with the delay in terms of payment as well, or restructuring of the debt. All these things come under the credit risk. And the dynamics of the recovery rate. When the recovery rates go worse and worse, that is also increasing the credit risk. So any kind of risk the company can expect from these dimensions, it falls under the heading of credit risk. Then comes the market risk. Any change in the market factors, whether it is interest rates or exchange rates, equity prices, commodity prices, any kind of loss the company can expect because of changes of these. Probably the commodity prices. Any company which is using A, B, C items as a raw material in its production item, in its production process, and if the prices of A, B, C raw materials are going to go up, the cost of production of the company is going up and the profitability is coming down. That means that portion has to be identified as a market risk. So prediction of the market risk and reduction of the market risk is very much an essential element. So those kind of risks where the company can lose because of the uncertainty that is associated with the market variables, the interest rates, the exchange rates, the equity prices, and the commodity prices. The third important risk comes out as operational risk, the losses the company can expect because of people, fraud, process failure, technology failure, computer program defect, all these things typically working out in terms of operations losses. See, generally a broad categorization wise, these three categories come up, but these three, what you could see is they can be applied to any company, either a financial firm or even a non-financial firm. And on one side, I could see the moment I categorize it, I can do some kind of computations. I can measure the different the quantum of loss that is associated with credit risk, market risk, operations risk. So some kind of measurement tools can come into picture. Manageability improves, transferability of the risk improves. So there is a positive side, but at the same time, it has been identified that the interdependencies among these, the moment I classify, okay, this is a market risk, this is a credit risk. Can risk exist like this? Or are there some risks which can fall into both the categories? Now, this is where the problem comes up. Anything where we can start arguing that it could be a market risk as well as a credit risk, then responsibility wise, neither the market risk manager takes much into it, or neither the credit risk manager takes much out of it. Or even if they take some kind of actions, they are specified to their areas of expertise. Now, no one looks at the interdependencies, which means the gaps and the risks, a few risks which are relating to the interdependency between them, that gets completely omitted and missed out. And even from an expertise perspective, I'll start saying, oh, I'm a market risk specialist. I'm an operations risk specialist. Instead of looking at risk on a broader picture, we start talking about a silo-based expertise and experience. Even in terms of personal, we'll find people more and more specialized in one form of risk. The terminologies, the measures, the tools that are being used, the systems, the data, everything gets aligned purely with respect to that classification. So cross communication will go worse and worse. That is one place probably this classification will face lots of criticism, and the more and more importance should come out with the communication and the interaction of the risk between the various types. Then probably this classification is going to do wonders, because a few of them, they use value at risk as a mechanism. Few of them may talk about outstanding balances as a mechanism. Few of them may come out with their own scoring model. All of them, they use different kinds of practices. So that is where we talk about the enterprise risk management becoming the need of the day. And just to talk about the enterprise risk management, its objective is to unify the risk, capital, and balance sheet management. Risk management, capital management, balance sheet management should be one and the same. Any process that I implement in the organization, any kind of tool or a technology that I bring up, it should not be talked of that this is a risk management technology or this is a capital management technology. There should not be any kind of differentiation. One implemented is going to support the other and vice versa. And we all need to appreciate that ERM is a goal. It's not going to come out in a day or two. It's an ongoing journey. There's a long way to achieve it. Probably think of it like a final destination for any kind of a company which wants to regularly improvise the processes, demonstrate advanced capabilities to typically make success in the business with effective implementation of the enterprise risk management. Of course, the more and more you are moving towards numbers, quantifications, one side there is a measurability, there is a number against which you can benchmark, you can monitor lots of benefits, but at the same time we really need to have that kind of an expertise to identify what kind of numbers are comparable. I can't just compute a number just to compare. Really identify which are truly comparable kind of numbers and work on them accordingly. Because we need to understand the limitations of each of them. When I say value at risk, yes, it's a good tool. It's a good number. It helps in comparison. But I really need to understand that it's a good risk measure only for those instruments where the market is following a normal distribution. For abnormal markets, for those kind of instruments whose prices are following a non-normal kind of a distribution, I cannot use this mechanism at all. So what we are trying to say is numbers are good, but don't carry away with the numbers, because every number that is computed, understand every formula that is being used to compute a number has its own set of assumptions, has its own set of limitations. So every computation should be done only after a proper understanding of the assumptions and limitations that go into the computation of that particular number. So there should be an integrity. How well a particular number is measured or quantified, it purely depends on the integrity of a robust control environment. Limitations and assumptions of each of the quantified formulas need to be understood before either accepting it or discarding it. Every task that they are doing, people should really understand and appreciate the critical significance of it, how well that particular single risk builds into the organization profile, to what extent it impacts the overall organization's revenues and profits is something which need to be appreciated by almost every employee in the organization. It should go as a part of the wider culture of the firm, not restricting to a single risk management department. So just to go in line with it, the risk manager, every company has created the role of a risk manager, and today it has even created a CXO position, CRO, the Chief Risk Officer, especially for banks and financial institutions. Today we see this kind of role being a very attractive kind of a role. If I look at from the past, any risk management, people perceive it with respect to risk avoidance and risk reduction. It is primarily looked at as a control function. But today things are moving. It is becoming more and more of a strategic position, We see for some of the firms, the person in the capability of a CRO has even become a CEO or a CFO, which means a control based role moving more to a strategic based role. So, as a risk manager, the major task comes in terms of identifying the sources of risk, make them clearly visible to the top management so that appropriate actions can be taken at the earliest, and even to the stakeholders so that they get the confidence when they want to either invest in the firm or lend to the firm or even provide the ratings to the firm. And as a risk manager, one important task comes out with respect to developing the tools for measuring the returns associated and corresponding the risks that are really taken by the firm to generate those kind of returns. And one thing, the risk manager is not a god, or he is not a fortune teller. He is primarily, so his job is not to come out with a point estimate. He is not giving a bullet point estimate of some particular value in the future. He is coming out with a distribution. This particular loss can lie between this amount and this amount with a 99% confidence. So he is primarily working out only on this distribution. Let's all appreciate this. He is not a god to do a forecasting or a fortune telling. Whatever the forecasting mechanisms that a risk manager is using is to come out with a distribution estimate of the future and explain the impact of to what extent the company can lose. So this is what is the help that a risk manager is providing in terms of the company taking effective risk management decisions so that the losses are within limit. They are not crossing heavy limits so that the company can shut down. So the risk manager is primarily targeted towards balancing the risk and reward to compete effectively. So his job is not just the reduction of the risk. The reduction of the risk should generate revenues in proportion to the risk taken, overall maximize the reward to the risk ratio. So the job is more in terms of implementing the appropriate policies, methodologies, infrastructure so that the overall value of the firm is going to increase. But yes, right from the beginning, it has been a very challenging role, generally not accepted. It is typically, the role is typically looked at as a control to the growth of the firm kind of a role, even by the senior management. There is a lot of political influence on that role. People lack the technical expertise, and overall, as a system, the acceptance to the role of risk management is declining, has declined over the period. So, the clear definition of the role and the reporting lines is very much critical. There should be an extensive interaction with the business, but it should be not dominating them. It should work with them. It should understand them. It should try to educate them, but not collude with them. That is when the risk management and the risk manager as a job are performing their best duties. And of course, every organization will have an audit function to typically review the risk management actions and their compliance. So, risk manager as a position becomes more and more important in the current world, especially after the debacle of 2007, where the overall financial losses boil down to the economy and there is an overall stagnancy in the economy across the world. So if I look at risk management per se, there are some positives in it. Probably if I look at the journey of risk management over the few decades, I could see that today good number of companies are adopting sophisticated risk management practices. Number of people who are trying to gain some kind of understanding in the world of risk is increasing. Professional certifications like FRM and PRM are creating some kind of interest in the investor community, interest in the business community. So the cost of implementing the various technologies is actually coming down. A good sign in the world of risk management. Even the compensation of the risk specialists is increasing period over period. The demand for risk management professionals is growing. Now the risk management based markets, tools targeted towards effective risk management have come out in the credit space, commodity space, weather space, lots and lots of financial innovative instruments which are addressing the risk management are coming up more and more. And this is making even the financial markets more and more innovative, lucrative contribution of the risk management. Lots of professional risk management associations like GARP, Global Association for Risk Professionals, the PRM, PRMIA, all of them are typically industry-based groups which are working towards improvisation and research in the world of risk management. And risk measurement scope has widened. Today there are measures, quantitative measures for measuring market risk, credit risk, operations risk. Things are coming out for effective measurement of different kinds of risks. And the role of CRO is creating interest among the risk management community, that a new career path got created. A person who is specializing in the world of risk, he can aspire to take a senior level position, a C level position in the top management cadre. All these things are working in favor of risk management. Whereas at the same time, we have been observing lots and lots of negatives with respect to the risk management. It's a big challenge to for a risk manager to balance between the fiduciary responsibility against the cost of offending, because even today the senior management is not receptive to the idea of risk management. I'm not saying all, but at least some portion or some number of people in the top management, they are looking at risk management as a control measure rather than a contribution measure. So there is a good possibility that any kind of practice that is implemented towards risk management, it can offend some of the senior officials. So this is where a challenge comes out with risk management role, balancing the responsibility of the risk management against getting offending some of the senior people in the organization. Another dimension, risk management is never a revenue generator. It can help the organization overall to become profitable, but it does not generate any kind of a revenue. So any kind of department which is a revenue generating kind of a department, it looks at risk management as something that is trying to pull out their revenue growth or pull out their profitability growth. Having unified measurements across the different kinds of risks, bringing about a unity among market risk, credit risk, trying to come out with uniform measures across different kinds of risk is a big challenge. Quantifying the data across the organization is going to be a huge task involving huge amount of resources and becoming more and more complicated. And especially if this perception among the organization employees goes like risk management is just a control function, and risk management is becoming too tight, it is becoming too averse to take the risks that will impact even the potential growth of the organization. So there should be a proper balancing. It can't be too restrictive that all the projects are omitted or given up by the firm. It should be a proper quantified kind of a way, proper analyzed kind of a way. So risk management should not become too cautious that it loses all the opportunities that come up as well. So there are some positives, there are some negatives. The way the organizations balance all of them make it more and more successful by implementing an effective risk management practice. Right? Now, just looking at a detailed breakup of different kinds of risks, a very interesting classification. Overall, we could see market risk, credit risk, liquidity risk, operations risk, regulatory risk, legal risk, business risk, strategic, and reputation. All these probably, if I look at the very, very broader perspective of risk, this is what it's going to be. And when I mean the world of financial risk, we are talking about the market risk as well as the credit risk. And in the market risk, generally we get these four major elements: equity price related, interest rate related, foreign exchange related, and commodity price. And again, within the interest rate, we are having a trading related risk or the gap related risk, which is more to do with the yield curve. Then we are looking at general and more specific, a kind of categorization that can go deeper and deeper. Similarly, in case of credit risk, we can talk about the risk with respect to the transactions and with respect to the concentration. And it could be more broken down into issue specific, issuer specific. Issue specific is the lender specific risk, the instrument specific risk, probably the bond instrument, the issuer specific, the borrower specific risk, and the counterparty related risks. All these can very well be built up into the credit risk. So probably as we move further and further, we keep understanding about each of these kinds of risk in more and more detail, but as a broader perspective, these are the classifications. And just going slightly to understand what each of them mean, when I talk about the market risk, any kind of market price change will reduce the value of my investments. Right? Any change in the market prices, the four which I talked about, a change in the interest rate, a change in the exchange rate, a change in the stock prices, equity prices, a change in the commodity prices. Because of these, if any of these four, if the value of my security or investment is going to get reduced, that is what gets classified as a market risk. Now, here we talk about two major forms of market risk, one being the general, which as a part of the market as a whole experiences it. Two is more and more specific. This particular company in the market is only facing that particular risk. And it can arise. What are the major causes for it? It can arise because of the unhedged positions. I did not take proper risk management against that position, or imperfect correlations. Whatever the investment that I have, I have not considered the correlation impact between them, interdependency between them, and that is where I have ignored the handling of them. And it goes by different terms, especially fund managers, they associate with the tracking error the same kind of market risk. And we see that there is a basis risk, especially with the derivatives and other hedging positions, wherein, okay, I create a relationship, okay, this loss can be reduced by investment in this. So a loss on this particular instrument is going to be compensated by this particular instrument. So that is what the initial correlation between them has suggested. But because these two have two different markets, it might very well happen today they have a proper relationship, but as we move down the lane, their relationship may get affected or broken, which means it could have fallen just slightly, but this could have raised drastically, or this could have fallen drastically, it could have raised, the other one would have raised limited. that difference between the two instruments, one for which I want to reduce the risk, which is my exposure, two, the instrument which I am using to reduce the risk, if these two are going in such a way that their initial relationship is getting violated, that kind of a risk is coming out to be the basis risk. And when we talk about the interest rate risk, the value of a fixed income security, so now the categorization of the market risk is into four: interest rate risk, the exchange rate risk, the equity price risk, the commodity price risk. So we'll deal with each one of them. When I talk about the interest rate risk, any fixed income security like a bond or a loan, the value of it falling because of the market interest rates rising. If the market interest rates go up, the bond which has been issued, the loan which has been given for a lesser interest rate is losing its value in the market. Because I could have lent at a higher rate, but I ended up lending at a lower rate, which is what is a kind of loss in the position. That is what we are attributing to the market risk. And at the same time, if the shape of the yield curves are changing, it's not a parallel shift, a non-parallel shift. Yes, a 5-year, the interest rates have increased, but 5-year loan rate did not change, only the 20-year loan rates have changed. So, even if the person has maintained a portfolio of a 5-year and a 20-year loan, corresponding to the interest rate change, his loan portfolio value has lost. So those kind of things are coming out to the yield curve kind of risk, basis risk can come out. So all these are contributing to the interest rate risk. Here the intention is just to understand the overview of each of these kind of risks. Working out on the equity prices as well, stock prices keep changing. So because of that, my positions can lose value. And anything that is more and more general, we are looking at the change in the value with respect to a change in the broad index. When I say broad index, it could be with respect to the Sensex in case of Indian Bombay Stock Exchange, or NSE's Nifty, any kind of broad stock market index. Or we are talking about Dow Jones, or we can talk about any kind of indexes across the world, or we can even bring in a Russell 2000 kind of an index. So it could be broader based index, which is a representation of the overall market. So any kind of sensitivity, I'm looking at my portfolio with respect to that broad index, that is called as general risk, which is measured with respect to a term called beta. Then we are looking at specific risk, which is more because of this particular company's risk characteristics. More specific to the firm, not generalized. And we all need to understand that general market risk is not diversifiable, because every firm in the industry, every firm in the market is going to have that much of risk. But the specific risk can very well be diversified by creating a portfolio. That is how we need to look at the equity price risk. Similarly, when we are talking about the foreign exchange risk, any kind of hedged positions which are open, which are not yet closed out, or which are imperfectly hedged. I don't understand the correlation between the two currencies, and because of that, I have not taken an appropriate action to reduce my risk. The improper or imperfect kind of hedging positions towards a particular currency is giving rise to foreign exchange risk. Any kind of cross-border investments that are being done, any kind of business operations that are being done with companies abroad, they are giving rise to more and more of foreign exchange risk. And of course, that is the uncertainties is giving rise to more operating losses, and that could even further halt the investment that can come into that particular firm. So overall, a proper imperfect correlations in terms of movement of the currency prices and the fluctuations in the international asset market, interest rates, All these are contributing to the foreign exchange risk being coming up. So the way to measure it, monitor it, manage it becomes very essential. Same logic goes with the commodity price, but compared to the equity price, something we observe with the commodity price is the supply of the commodity is concentrated only with a few suppliers. So they are going to really collude, they are really going to influence the price. Whereas in the typical stock market, we see that the price is not that heavily influenced by one or two players, but in the commodity market, it is. So price volatility becomes much higher in the commodity market, and at the same time additional things that get added up towards a community, how commodity, how easy it is to store it, what is the cost that is associated with storing it, what is the kind of perishability level that is associated with it, which creates huge price discontinuance. It's not a kind of a smooth price increase or decrease that can come out. We see that the perishability, the ease of storage, the cost associated with storage will really influence the overall price of a commodity, and that is where the overall commodity world classifies commodities into hard commodities and soft commodities. Hard being those ones which are rarely perished, mostly unperishable kind of quantities. Again, they get further divided into precious metals like gold, silver, and base metals like copper, tin, aluminium, etc. Whereas on the other side, especially for the soft commodities, again we see a classification: agricultural commodities and energy based commodities. Agriculture, again we have cotton, turmeric, those kind of commodities coming up. Energy based falling into the electricity, the oil, the fuel, these things coming into the energy based kind of commodities. Now, looking at the credit risk, we are bringing in the change in the credit quality of the borrower, worsened credit quality of the borrower. It is affecting the value of the security. If I see that this person may default, that is where my loss is going to increase, because I will not get money from him in a timely manner. So looking at the unwilling and unable counterparty in terms of fulfilling the risk, so fulfilling the obligations and the commitment is giving rise to credit risk. So generally, whenever the position of when a position is an asset, when I see that it is positive to the lender, that is where the credit risk is going to come into picture. When the value of the position is negative, when he is losing, obviously the counterparty may not default on it, but when this particular position is positive, that is where the other counterparty can default. So this is very much possible only when the position is an asset, positive value to the lender. And whatever is the loss, in case it can't be recovered, we are calling it as loss given default. So we are clearly looking at how much loss can occur even after the recoveries happen. That is what is the real risk to the lender. And what we really need to understand is, for typical simple loans and bonds, it's not that difficult to compute it. But derivatives position, it is going to be much complicated. One thing, the value is much lower than the notional amount because it's only the difference in the values that is at risk rather than the overall amount. And it is very much dynamic. The position could be negative today, tomorrow it becomes positive. So today it looks as if there is no credit risk, tomorrow it looks as if the credit risk has gone up tremendously. Because of the marking to the market settlement that happen, the positions keep changing very dynamically. So that is where we really need to be careful when we are looking at the credit risk in derivative instruments, just not looking at the current exposure levels, but potential future exposure levels also very clearly need to be looked at and evaluated. Now, talking about the liquidity risk, on a broad base, we have two major forms of liquidity risk. One is with respect to the funding, the other is with respect to the value of the asset. Funding comes from the perspective of the ability of the firm to raise the necessary cash to meet the requirements. In the short term, company needs to meet the margin requirements. Company needs to roll over its debt. It needs some kind of cash. But if it is not able to raise short-term capital, short-term funds, if it is not able to raise short-term funds and it is losing out, that is what gives rise to funding liquidity risk. Whereas on the other side, when I bring in the asset liquidity, the company is having some assets A1, A2, A3. Now it wants to sell off these assets at P1, P2, P3, but there are no buyers for it. So if it is not able to sell off, it will lose its position badly. Or if it is selling off, it has to sell only at probably a very discounted prices. Instead of P1, it may be forced to sell at 80% of that. Instead of P2, only 75% of that. So it is not able to sell out its asset in the market at its market price. Rather, it has to sell it at a very lesser price, compromised kind of a price. Means the company is not in a position to dispose of its assets or to sell off its asset at the fair market value because there is no counterparty who is willing to purchase it. And that is what is creating a substantial loss on the position. That is what is giving rise to asset liquidity risk. And what we typically see is for a firm which is undergoing through a bad phase or whose liquidity risk is there, it can even give rise to asset liquidity risk. And even a firm which is having a heavy asset liquidity risk, it can very well get integrated into a funding liquidity risk as well. Now looking at operations risk, the focus is more on the internal processes. Systems are not good. Management approach failure. Control systems not in place. Fraud by the human beings. Human error. Computer programming error. Intentional falsifications. The losses the company is getting because of all these internal activities is giving rise to the operations risk. And probably if I look at in the last couple of decades, the major financial disasters that have occurred, majority of them can be attributed to operations risk in some form or the other. Fraud by some of the employees, giving rise to huge losses, winding up of businesses, getting bailed out, are probably going bankrupt. All these things, majority of the instances, they can get mapped to the operational risk. So that's the reason the operational risk and the management and measurement of the operational risk becoming very critical in the today's world. The derivatives trading is giving more and more scope for operational risk because it's a very heavily leveraged kind of a business. In order to create heavy profits, heavy amount of leverage taken, and in case things are not going in the direction, even the other the companies and some staff within the organization, they are getting into the process of tampering the data so that they can show a better profit even in reality if they are not. Valuation difficulties are mounting up day over day. So if at all the company needs to put effective processes in place, tight controls need to be done for the operational risk management to become more and more successful. And looking at various other forms of risk, there are a few legal, regulatory related risks because there is a possibility that the client can sue the provider for not meeting up the obligation because sometimes As an investment advisor or a portfolio manager, I may give a kind of I may talk to my client and say I'll generate you 12% return per year. In case I'm not able to generate that 12% return, there is a very much a possibility that my client sues me for not being able to generate that 12% return. So that is where we are talking about a legal risk or a regulatory related risk coming up. Any change in the tax laws can have an impact on the value of the position. All these things bringing rise to either the legal or regulatory kind of risks. Now looking at the strategic kind of or probably a business risk, something to do with the core business operations. Any loss the company can expect to crop up because of the business related functions. Uncertainty relating to the demand for that product. Uncertainty relating to the price that we are going to charge for that product. Uncertainty relating to the cost of production of that particular product. All of them are giving rise to business risks. And one simple thing is, it is the one that is expected. This particular thing the business is going to willing to take up because it is expected that all these business things the company would have really planned out and they are going as a part of the core of the firm. So it cannot reduce these kind of risks. It is intentionally taking up these risks, but it needs to have a good understanding of these risks. So core tasks of the management are really controlling them, and they are excluded from the regulator's definition of operational because it is expected that the companies will bear it in line with their business. It's not something that is alien to the business community. And that again can get classified into strategic. Any investment the company is making where there is high uncertainty about the success and profitability. Huge investment made into one single project or one single unit, business unit, where the uncertainty is very, very high with respect to the profitability. That is what is giving rise to strategic risk. It can be driven by market variables or credit variables. Probably it looks as if, okay, if you want to invest in a particular infrastructure business, the loans are given just at 2% interest rate. Now that makes the company, without any proper strategy, come out with a huge investment and invest in the infrastructure business. Or probably if the government regulation changes in such a way that any investment in the airline sector will be given a tax subsidy for the next few years. Now immediately there are lots of firms which can show heavy interest in terms of doing heavy investment in the airline sector because they find that it to be more lucrative. So this is what we are giving rise to strategy risk. And on the other side, we can even talk about the reputation risk, especially with respect to the corporate accounting scandals. The chance that the firm loses its reputation, gets difficult to bounce back into the business, losing the confidence of the customers, the creditors, the regulators, and everyone. That's going to be a very heavy, painful risk for the firm. So this is what is a very high level overview of risk management, the need for risk, the various types of risk, what is the typical way the risk gets measured, managed, so that the overall profitability of the firm gets quite enhanced, right?